Every single financial expert told you the same thing at the start of this year. The Fed is going to cut rates in 2026. Cheaper mortgages, cheaper credit cards, cheaper loans. That was the plan. They were wrong. Right now, in 2026, the Federal Reserve is doing the exact opposite. They're talking about hiking rates. And if you don't understand why this is happening, you are going to make expensive decisions this year with your mortgage, your savings, your investments, and your credit cards. In the next 10 minutes, I'm going to show you exactly why this reversal happened. And more importantly, at the 7-minute mark, I'm going to give you the 3 specific moves you should be making with your money right now, before most people even realize what's going on. Let's get into it. So here's the story going into 2026. The Fed had been cutting rates since late 2024. By the end of 2025, rates had come down over a full percentage point. Everyone, investors, homeowners, first-time buyers, was told the same thing. Rate cuts were coming. Borrowing was going to get cheaper, and the economy was going to loosen up. Then something changed. Inflation, which was supposed to keep falling toward that 2% target, did the opposite. It went up. And the Fed's own language changed with it. Instead of talking about supporting growth, they started talking about price stability over and over again. That phrase alone is a signal. When a central bank starts repeating price stability, they're preparing you for higher rates, not lower ones. So the question is, what actually flipped the script? There are 3 forces stacking on top of each other right now, and you need to understand all 3 because they don't fix themselves quickly. Number 1, energy prices. Oil prices spiked hard this year, driven largely by conflict in the Middle East disrupting supply. And energy isn't just a line item. It feeds into literally everything. Transport costs, manufacturing costs, food costs. When oil jumps, inflation follows a few months later, almost like clockwork. That's exactly what happened here. Number 2, tariffs. A new, much higher tariff regime has been in place since last year, and the pass-through to consumers has been bigger than expected. Over half of that tariff cost is landing directly on the prices you pay at the store. Tariffs are, in effect, a tax that shows up as inflation. Number 3, leadership change at the Fed. There's a new Fed chair now, and his public message has been blunt. Fighting inflation comes first, even if that means rates stay higher for longer or go up. Markets listened, bond yields moved, and suddenly the rate cut story that everyone was banking on for 2026 quietly became a maybe 1 or 2 hikes story instead. Put those 3 together: expensive oil, tariff-driven price increases, and a Fed chair who wants to prove he's serious about inflation. And you get exactly what we're seeing. A Fed that paused and is now leaning toward hiking instead of cutting. Okay, here's where it gets personal, because this isn't just a headline. It changes real numbers in your life. Your mortgage. Long-term borrowing costs are tied closely to Treasury yields, and those yields have already climbed. That means the 30-year mortgage rate has moved higher this year too. If you were waiting for rates to drop before buying a home, that wait might get longer than you planned. Your savings account. This is actually good news for once. Higher rates mean savings accounts, money market funds, and short-term CDs are paying you more. If your money is just sitting in a checking account earning almost nothing, that's a mistake you can fix today. Your credit cards and loans. Variable rate debt. Credit cards, some personal loans, adjustable mortgages gets more expensive when the Fed holds or hikes. If you're carrying a balance, that balance is about to cost you more, not less. The stock market. Higher rates usually pressure stock valuations, especially for growth and tech stocks that rely on future earnings. But right now, we're seeing something unusual. The market is still near all-time highs, propped up heavily by AI infrastructure spending. That's a tension point worth watching, because eventually, either the AI growth story has to keep justifying those prices, or higher rates start to bite. Here's something most people miss. The Fed doesn't move rates based on this month's number. They move based on trend and expectation. Right now, core inflation is sitting well above the 2% target, and it's been trending up, not down, since the start of the year. Historically, when a new hawkish Fed chair takes over during a period of rising inflation, they tend to overcorrect early to build credibility. That's exactly the setup we're in. This also connects to something bigger, the U.S. government's debt levels. Higher rates mean higher interest payments on that debt, which affects the entire fiscal picture. Bond investors know this, which is part of why long-term yields have moved up, even beyond what the Fed's official rate suggests. The market itself is pricing in a higher-for-longer reality. This is the part I promised you at the start. 3 practical moves based on everything we just covered. Move 1. Park idle cash where it earns. With rates elevated, high-yield savings accounts and short-term treasury funds are paying meaningfully, more than a regular checking account. If you have cash sitting idle, this is free money you're leaving on the table. Move 2. Attack variable rate debt first. If you're carrying credit card debt or a variable rate loan, prioritize paying that down before rates climb further. Every month you wait, it gets more expensive. Move 3. Stress test your portfolio. Don't panic sell. If you're heavily weighted toward high-growth, rate-sensitive stocks, this is the moment to check your diversification, not to abandon the market. Historically, sectors like energy and utilities tend to hold up better in a higher rate environment, and that's already showing up in this year's performance data. None of this means sell everything or hide in cash. It means understanding the environment you're actually investing in, instead of the one you wish you were investing in. So here's the real takeaway. The Fed didn't change its mind randomly. Oil, tariffs, and a new chair focused on credibility all pushed in the same direction. And that direction is higher rates, not lower ones. If you are planning your finances around rate cuts this year, it's time to update that plan. I track this stuff every single week. And the moment the Fed's language shifts again, toward cuts, toward pauses, toward anything, I'll break it down here before it hits the mainstream headlines. So if you don't want to be the last person to find out your mortgage, your savings, or your investments just changed, you know what to do. Subscribe, and I'll see you in the next one.